Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
The information in this episode is general in nature and does not take into account your personal objectives, financial situation, or needs. Nothing discussed should be considered financial, legal, or taxation advice. Before making any decisions, you should consider whether the information is appropriate for your circumstances and seek independent, professional advice from a licensed financial advisor.
And welcome back to another episode of the Defence Property Podcast. I'm Kane Drury from Discover Buyers Agency, your host. We had Jesse from BBS Tax on a few weeks ago, and we're back in the podcast with Jesse talking all things tax, because it is that time of year where we need to be aware of what we're claiming, what we're not claiming, and sort of stamp out some of that barbecue mafia or boozer tax talk, I guess. So Jesse, welcome back to the podcast.
Thanks for having me, Kane.
Nice. So I guess kick us off, like you're ex-military yourself, so you're pretty familiar with the military way of life. I guess start through sort of some of the more common tax deductions for the everyday soldier, sailor, airman, relative to their role in defence.
Yeah, so defence is a like everyone thinks it's really complicated and different. It's not.
Yeah,
we've got some basic rules for deductions. You have to have spent the money,
yeah,
and it's got to relate to earning a taxable income.
Yeah,
when we say taxable income, that's a kick in the teeth for all our reservist mates, because your pay, unless you continuous full-time service, isn't taxable, so nothing you spend on that job is deductible.
So it's fair to say this episode does not apply to the reservists, or broadly.
Poor guys, no.
Yeah.
But apart from that, it's like anything you've spent, you had to. So, if you're buying some Gucci kit, that counts.
Yep.
Our uniforms count. Laundering our uniforms count. If we have to travel from home to work with our pack to do our pack march once a week, and we don't have anywhere secure on base or at unit to store it, then our car use for that counts. Just driving to and from work, just with our backpack to go to work each normal day,
does not count.
Doesn't count.
Yeah.
If we have to travel for courses, it's not reimbursed or anything. That counts. Our uniforms, our laundry, our gongs, cleaning, laundering, mending, that stuff counts. Most training you don't pay for when you're in the Army and Navy and Air Force, so we don't really have any of the training or education deductions.
Yeah.
And then, all our gear, our boots, if we're buying boots, watches are normally a personal expense unless it's a specific occupation watch. Yep. So if it's like a heavy duty mudman, sure, you're not getting away with the Rolex. That's not counting.
What about the old G-Shock?
Yeah, the G-Shock mudman. Yeah, it's like the heavy duty one that's designed for it. Yep.
Well, let's go through some of the probably the more grey area ones. Yeah. We'll start with the black Oakleys.
No,
I'd almost bet my left testicle that a shitload of black Oakleys have been claimed. Not saying they are or they aren't, but
if you work outdoors and it's genuine sun protection, you work outdoors a lot of time, sunglasses are claimable.
Cool.
You're supposed to apportion private and work use, so just buy two pairs and have one pair for home and one pair for work. Yeah,
well, I would imagine most sunnies that people wear on their weekends and that have vastly different to what's ASOS compliant.
Yeah.
So, cool. What about sun cream and stuff then?
Sun cream, 100%. Yep.
Cool. What are some of the other sort of more curly grey zones? What about a swag?
Yeah, if you buy it and it's solely for work purposes, fully deductible. If there's a split between private and work, you've got to apportion it to work out kind of the percentage you claim. While we're on the topic of buying equipment and tools, anything under $300 is immediately deductible. Anything over $300 is depreciated over the effective life of the asset for individuals. So you can't go out and buy a $1,000 piece of kit thinking you get a $1,000 deduction, because that one's going to go over a certain number of years.
Yeah, okay. And is the effective life on most things varied?
It varies depending on what it is. And the HO do keep tables that tell us.
Yep.
Great thing about defence is not a lot of stuff's on that table, because it's pretty wildly different to normal stuff. One that catches people out is gym fees are not deductible unless you're SF or a PTI.
Okay.
Or whatever the equivalent is in
What about
the Navy Air Force.
our joggers, our normal pair of Asics?
Nope. Joggers, socks, shorts aren't unless
PT
they're
gears, not?
unit or service shorts with the logos you buy through the uniform shop.
Yep.
Regular workout T-shirts aren't. Unit, subunit, and service PT shirts are. So as long as they got the emblems on them, the logos, or they've got a great big company logos on the back.
Yep.
They're deductible because they're considered part of the uniform.
Yeah, cool.
But if you just go buy a Nike shirt, no dough.
All right, so we're already at a no, but we'll go further into the grey zone. What about gym equipment for the home gym and bits and pieces?
No, surprisingly, we're not considered to have a greater level of fitness than the average person.
Shit.
I remember when the Pezza came out.
Yeah, right.
That shit was wild. I never had to do one because that's right. It came out just after I hurt myself. But I'd watch dudes dropping on that, and I'm sitting there going, not more fitness than this person. It's kind of ludicrous, but they're not going to budge on it.
We need to get some of the old cake eaters from the ATO out on the field and put them side by side with the defence guys and see.
Let everyone just beast.
Yeah, just see if the defence have a high level of fitness and should be able, that's a bit of a hairy one in my eyes, but cool. What are some of the other? What about travel? Where does any sort of, obviously the defence is paying for travel to courses and stuff, but does travel to any sort of location come into play?
Nah, if it's all paid for, then it's not. And I don't really know of. And usually if you do have to travel, defence pays you an allowance anyway, or per diem.
Yeah.
So that's caught. Mobile phones is one you can claim. If you can genuinely show, and you're supposed to keep a logbook to show your work versus personal usage, and you can claim that percentage.
Yeah.
And since we're all on call all the time, we've got to be able to be contactable, and we've all got to have our mobiles on us because our secco will message us from upstairs, say, hey, need you guys to go do this thing. There's definitely going to be at least some work use.
Portion,
so we can claim it's just a case of, have I kept the records? How hard is it to keep the records?
Yeah.
Do I want to keep the records? If it's pretty minimal, is it just pain in the ass?
Yeah, okay, cool. And being a property podcast, I guess there's plenty of defence members out there that own residential property. So let's just talk through some of the things, because this could probably, go on forever, I guess, of what is and what isn't. And there's probably a lot, depends on people's views as well, but we'll keep it high level for today. Obviously, we got interest on the loan.
Mm-hmm.
So that's the tax deduction. Again, you got to provide evidence. So 30th of June, get your loan statement. And there should be interest for the whole year, and that's a tax deduction. What else are we talking when it comes to property?
With property, so we'll break it down a little bit. When you purchase a property, none of that is deductible. That all goes on your cost base when you sell it.
Yep.
So that includes like your conveyances fees, building and pest, any of that kind of stuff, your loan application fees.
Yep.
None of that counts.
Lenders
and then
mortgage insurance is one.
Yep, LMI. And then once LMI is deductible over 5 years.
Yeah, okay.
Yep, because it's a cost you pay
Yep.
to have the loan, not the purchase. Then we look at things like, let's just start at the top, advertising for tenants, body corp, council rates, cleaning, gardening, or your property management fees for your property manager, repairs. Repairs is a funny one. Your depreciation that we talked about a little while ago. So you do need, usually when you purchase one, to get a quantity surveyor report from a qualified surveyor to break it down for you. The cost of getting that report is not a rental deduction. It goes in another spot for your cost of managing your tax affairs. Yeah, okay. And you claim there the same thing as when you pay your tax agent, pay your return. And then there's just anything else associated with earning that rental income. No traveling anymore. Got rid of that in 2017. So you can't claim for travel to go inspect the rental property.
So if you've got an investment property in South Australia and you live, or let's say you live in South Australia and you've got an investment property on the Gold Coast, there's no more holidays to the Gold Coast that you're claiming anymore.
None at all.
I'll just go back a step as well. And just the cost base of the property is if you pay $1 million for it, but like Jesse said, if you've got, say, some stamp duty and some other expenses to acquire that property, if your stamp duty was $50,000 with some other costs, when you pay your capital gain, the cost base is the price plus those associated costs, and it's worked out of, say, $1,075,000 in this example. So, that's what the cost base is.
When we can take it a step further. Your cost base there's 5 elements of cost base, but for us, it's the purchase price of the asset, all the costs to purchase the asset and get it ready for use to earn income. And then when we sell it, all our selling costs as well.
Yeah.
So you don't know the exact figure until everything's done and dusted. The other thing that bites with residential real estate that a lot of people don't know, and it hurts when they do the calculations, and I've seen a lot of accounts miss as well, is any of the depreciation we count on the capital works, or what we call Div 43, which is the actual structure of the building. So, like the concrete, the walls, the tiles, all that kind of stuff. We can claim 2.5% over 40 years as depreciation on that. Whatever we claim gets reduced from the cost base.
Yeah.
Because otherwise we're having 2 bites.
This is a big one that never gets there's a lot of companies out there that will sprue or say buy a property, all this depreciation, get the tax back. But people don't tell you that you're paying that back. So it's an on paper loss that you're claiming as an immediate deduction. But when you sell that property, your cost base, if you buy a house land package, $1 million, 500,000 land, 500,000 build price. If you own that for 40 years, claiming your 2.5%, cost base drops to 500,000 because you've essentially owned it for the 40 years, claimed the full depreciation. So your capital gain is calculated off 500, even though you paid $1 million, ignoring the initial acquisition costs.
Yeah,
for the cost base. So, look, if you're never going to sell it and you intend on dying with it, it's not your problem. But it's very important to be aware if you're buying a property. A lot of these companies will push a brand new house and land to, get depreciation. If you intend on selling that during your lifetime or working career to roll the profits into your mortgage to reduce your mortgage, just be aware that your cost base is decreasing by that depreciation you're claiming, which is not often spoken about or explained to, to the end consumer.
Yeah, it is. And now with the new budget, I guess we've got the 2 factors now. Did I own this negatively geared property before budget night this year, or did I purchase it after? Because before budget night, we can keep negative gearing. It comes off our income. After budget night, we can do it again for this year up to 1st July 27. And after that, it's only on brand new builds you're purchasing as a first purchaser. Any established ones, we can still calculate the loss with the negative gearing, and it just gets carried forward until such time it becomes positively geared, and we can reduce that down. And if we still have some left over and we sell it, it increases our cost base.
Yeah.
So we don't lose it forever. It's just shifted to a different point.
Yeah. Yeah. And I guess this is probably a good way to move into the quite a common misconception with property and deductions. There's rental repairs that are immediately deductible, then there's capital improvements which are not immediately deductible. So if you go slap a new kitchen in the rental property and you spend $20,000, you're not getting a $20,000 immediate tax deduction. That's generally the new kitchen is a capital improvement and you're depreciating it over a certain amount of years. Whereas if, say, the kitchen cupboard door is broken and you have to send a chippy out there to go replace the door and buy some new hinges and the door and whatnot, that's a repair and that's more likely going to be deductible. Correct?
Correct.
Yeah.
So, there's a lot of case law about this.
Yeah.
Basically, if you're replacing a part of the asset that makes it work, it's a repair. If you're replacing or fundamentally replacing or improving the whole asset, it's an improvement, and it's not immediately deductible. So, example, I've got an old wooden fence, a couple of palings fell down. I bought new palings, nailed them back in. I had a trader come out and do it. That's a repair. That's fine.
Yep.
Timber fence falls down, gone completely. I replace it with an upmarket Colorbond or concrete Besser block fence. Yep. That's an improvement, not deductible, even though I had to repair something.
What if you replace it with so not fixing paling by paling, but you replace the whole fence with a like for like?
You're limited to fixing what was wrong. So if 3 palings fall off, you go, let's rip it down and put a whole new, brand new wooden one up.
Yeah.
It's not a repair. It's an improvement again. The other part is, you have to use the equivalent of what it was. So if it's a wooden fence, the whole thing falls down, you go, it's only a little bit more to put up a Colorbond than a wooden. That's an improvement because it's
But if it's a 40-year-old timber paling fence up in North Queensland has been exposed to the Townsville sun for a long period of time.
Cyclone comes through, knocks the whole thing down. I put another timber one up, no dramas, repair.
Okay.
If it's any kind of improvement.
So most of the bigger repairs are probably going to be covered by some sort of insurance event anyway, So
the other before we move on, the other real fun part of this is if I go buy a beat up shack and go, it's crap, I need to do a bunch of repairs and improvements so I can sell it.
Yeah.
It's a generally accepted rule. Anything you repair within the first 12 months, you don't get a deduction for.
Yeah.
Because it's considered that you bought the property for less to factor that in. And so basically it's within 12 months, repairs are considered too soon. Yeah. And you won't get immediate deduction. They're depreciated as improvements.
Depreciated as a capital improvement because you bought it with the intent to tart it up a little bit.
I've seen some people get burnt by that where they go, we had to spend 50 grand, here's my 50 grand deductions. And I go, nope, go see a quantity surveyor. And
so would it be a common strategy for someone a bit more experienced to maybe buy like property that you mentioned, hold it for 12 months and then carry out the repairs that it needs? Are we getting a little bit grey there?
It's getting a little bit grey because, if you walk in and it's like, I'm repairing the kitchen bench because there was a crack in it, to I'm ripping out the kitchen and putting a whole new one in, it's still an improvement. It's still in accounting. Yeah. But it's where you go in and things like, I've got to replace the carpet because there's big tears and stuff in it, or there's a bunch of, the door was off the hinges. It's factored into your purchase price. They're not going to allow it.
But ultimately, we're going to make this back anyway, aren't we? Like if we're depreciating, most of these items are 4, 5, 7 years when we're talking depreciating.
Yep. So there's two different things. There's what's called capital allowances or Div 40, which is all our plant equipment. And essentially it can be taken out of the premises. It can be removed fairly easily. So things like your stoves, your air cons, blinds, that kind of stuff. And then we have Div 43, which is our capital works, which is our studs in the walls, our roof beams, our concrete, all that stuff can't be taken out. And they both have different rates. So our works are at 2.5% over 40 years, set rate, can't change it. And all our other assets have effective lives, each of them.
Each great big table asset has a different,
great big table for it.
Ultimately, if we're spending, like in these scenarios that we're spitballing here, $20,000 on a kitchen and a bathroom, we're still going to get it as some form of tax deduction and benefit. We're just not going to, don't go into it thinking you're going to spend 20 grand on a kitchen and going to immediately reduce your income by 20,000. No. It doesn't work like that. Yeah. No, and that's the key. But you still get a benefit, and it's going to, that benefit is going to be over, 5, 7, 10 years or whatever.
Yeah.
Yeah. Cool. Well, haven't we covered? What about insurance and stuff and body corporates and stuff? Any common misunderstandings or areas where people go wrong?
If we want to get real technical, the admin fund and the sinking fund in the body corporate, one's deductible and the other one's not.
Yeah.
I don't know of a lot of places who strictly stick to that rule. But if you have to spend it to earn the income, it's deductible. Insurances, if it's for landlord insurance, it's for the contents possibly, and then if building insurance, if it's standalone building, if it's part of a strata, it's going to be called in the body corp.
Yep, and your body corp is deductible in that scenario anyway. Cool. So what are some of the things that people, obviously travel is the big one because it used to be deductible, it's now not. So that's probably one that people are misunderstanding, like you mentioned, who got stamped out in 2017. Yep. And what are some other property misunderstandings with deductions?
I think we've covered a fair chunk of them.
Yep.
Yeah. The biggest ones are just kind of repairs is usually the biggest one. The depreciation. I do see a lot of people who don't get depreciation schedules.
Yeah.
They're just costing themselves money. Yeah. Even though you have to add it back at the end, the benefit's still worthwhile.
I really encourage that as well because most quality or decent quantity surveyors out there, they'll tell you you'll generally make the cost of the report back in the first year and the deductions that you make. And unless you're buying something like Jesse mentioned, the building can be depreciated over 40 years. So if it's less than 40 years old, 99 times out of 100, it's worth getting. If it's older than 40 years, most decent quantity surveyors will tell you, hey, I probably wouldn't spend the money on this. Essentially, if it's in original condition, 40 years or older, you might ask the question, is it worth doing? But if it's 40 years older and it's been renovated, still ask the question and get the report potentially.
Yeah.
And most quantity surveyors, like I said, will point it out, hey, don't waste your money on this one. So, definitely look into that. If you need a connection, reach out to us. We work with a couple of good quantity surveyors Australia-wide. What about record keeping? This is probably, back in, when I enlisted, at least 2001, it was normally a shoebox full of receipts and stuff that got handed over to the accountant, and they would spend hours sifting through these receipts. What's best practice for record keeping these days?
Well, you need to keep a record of everything you're claiming, and you need to keep it for 5 years after the date of assessment of the tax return for that year. So let's say, year just gone 2025, I lodged that return last possible minute, 15th of May.
Yeah.
I got my assessment notice on the 22nd of May. For 5 years from the 22nd of May, I need to keep all my records that relate to anything in that tax return.
Yeah.
Now, here's the kicker when you have rental properties. If you bought one 20 years ago and sold it that year, the record keeping requirements for keeping my original contracts and stamp duty and solicitor's invoices are 5 years from the notice of assessment the year I sold it. So some of those records can be 30, 40 years old where, original contracts you have, maybe not the invoices. But I tell everyone, for those big things, just get a manila folder or like one of the old envelopes, stick everything in that and put in like a filing cabinet, something with tax written on it.
Yeah.
Just do that every year. And on that one, just go purchases for the property.
Yeah.
Or, if you like to digitize everything, scan it through the computer, put it on a hard drive, make sure each time you upgrade your computer, you're bringing that stuff across. Because if you don't have it, you're going to miss stuff.
Yeah. So I'm going to go on a limb here and put it out there that there's probably people that haven't done that have got property that they brought, 10, and it's not from a point of trying to avoid or hide or anything. They just don't know, ignorance, and, they've not kept a lot of that information, especially like if we're going back 20 and 30 years, what happens? And they sell it today. What does the accountant do, or how do they work it out, and how is that viewed?
Usually we can still find the purchase price of the property with council records. The stamp duty, if you know when it was bought, you can usually work out what it would have been.
Yep.
Anything else, if you don't have like your cost of your conveyancer, gone.
Yeah. Just can't claim
building and pest, gone, that kind of stuff, you miss out. And we do see that fairly regularly.
Yep.
People also lose their records. Houses flood, houses burn down. It's horrible. People move and go, we don't need this, and toss it out.
Yeah.
Which
is probably a
kids
common
get
one
a hold
in
of it and
defence.
scribble stuff all over it and cut it up into little foldable men.
Yeah. Yeah.
But we do the best we can, but there's going to be things you miss then.
Yeah. Okay. And probably the moving is the biggest risk, isn't it, with defence, knowing that we move, like every 2 to 3 years, potentially in a new locality, but also if we do back-to-back postings in one area, still move on base, off base, rentals and DHA and stuff. So,
and the other thing with digitizing, you can also just, email it to yourself and stick it in an email folder. It says important documents. That way, you're not going to lose it on a hard drive. You're not going to lose a computer. As long as you've got access to email addresses, it's just going to sit in the cloud forever.
Load it up to Gmail and let it sit there. Have a folder as well, if you can, so you got redundancy there.
Yeah.
Okay. And what about for, the non-property record keeping, just for the defence in general? Anything specific they need to,
Same rules apply. It's 5 years from the date you got the notice of assessment.
Yep.
There are certain things when you look at the HO instructions, they say you don't need substantiation for this as long as it falls kind of within these thresholds.
Yeah.
And now the big caveat is the second we audit you, you must substantiate everything. So even though you don't need to prepare the return, you can say, we're not going to worry about that.
Can you give us an example of what?
So for individual tax returns, they say, up to $300 expenses, you don't need substantiation for. It's generally acceptable.
Yep.
And that doesn't mean you just claim $300.
Yeah.
It means, just you're not required to keep every receipt if your total deductions are less than $300. Not many people less than $300. The other part of that is they then decide to audit you. They go, well, show us the substantiation for it or how you worked it out. And 5 years later, you're probably not going to go, oh, well, I had to wash my uniform, twice a week, every week for 48 weeks.
Yeah.
That gets me, $144. You're not going to remember that. So there's tricky things like that where they say, don't worry about it. But if we come after you, worry about it.
Yeah. Yeah. Interesting. Sure. Has that been ever questioned? Like it seems a little bit.
A couple times, yeah.
Yeah. And it's just too bad that's the system.
Yep. Yeah. The other part is, I've said it before, but it has to relate to your taxable income.
Yeah.
And I have had a case where a guy owned the business. He was working in it the whole year, spending money, only started paying himself wages in kind of the last 4 months. And they said, everything before that doesn't count. You won't earn any income. So even though he had to spend the money and put himself kind of in a loss position to get it going, then when he started earning the income, they said, no, it doesn't relate to income. because you only started paying yourself from this date. Anything before that doesn't count.
Yeah,
Even though
right.
you're doing the work, you're working 40,
Yeah.
50, 60 hours a week. They said, no.
Interesting. Well, I mean, today's episode is not about turning every listener into an accountant. I'd hope that most people that, whether they've got property or not, are using an accountant. Definitely, if you've got a property, I would strongly advocate for using an accountant, especially someone that's familiar with property like Jesse. But even if you don't have property, I feel that, an accountant's always going to put you in a better net position, post that tax return, because they're going to know, one, they're going to put you in a better position and hopefully get you a better outcome, but they're also going to keep you more compliant, if that's the right term, So, Jesse, appreciate you coming on the podcast. For anyone that's listening, where can they find you?
www.bbstax.com.au. Jump on there. There's a contact form. I'll get all your info from that.
Perfect. And if you can't find it, reach out to myself. I'm happy to connect anyone via email to Jesse. And you can look us up at discoverbuyersagency.com.au. Thanks for listening. Jesse, thanks for coming on.
Thanks for having me.
Cheers.